The U.S. has just imposed tariffs on China, Canada, and Mexico. Canada and Mexico responded with like tariffs on the U.S. imports. But what I want to go through now is that not all tariffs are created equal. Canada and Mexico have matched the percentage of the tariff. The economies and their size are dramatically different. And the impact of the tariffs to the economies are going to be wildly different. And there are going to be some winners and losers in this new tariff trade war. I'm going to unpack for you right now the winners and losers in this tariff by comparing the economic impact of the tariff. Because just because they match the percentage doesn't mean the impact to the citizenry is going to be the same. Let's dive right into it. So what I have here is economic data from tradingeconomics.com. I've kind of smell checked this data in Google and other sources. I think it's directionally correct. Everything is in USD and billions of dollars. Again, all of this is going to be subject to the impact of these tariffs, and people can move their manufacturing, they can import less. So holding everything else constant, let's see what happens. Mexico is currently the U.S.'s largest trading partner. U.S. imports $450 billion of goods from Mexico. There's a 25% tariff on all those imports. That is $113 billion of annual tax revenue into the United States as a result of the tariff. The U.S. economy is $27 trillion. That means the impact to this in terms of the trade value against the economic size is 1.7%. And if I take the tax revenue that the U.S. will receive against the economy, we're talking a 0.4% of the trade volume. So 1.7% is relatively low in terms of messing with this number, and the impact it's going to have on the overall U.S. economy is relatively low. Canada, roughly the same, $473 billion of annual trade inflow, 25% tariff, $100 billion of annual revenue. That's 1.6% of the U.S. GDP. China, 448, 10%. That's $45 billion annual revenue, 27 trillion. It's 1.7. Now, I'll show you why he used 10% here, because in a future, when we look at the trade relationship between how much leverage the U.S. has with these countries versus China. I've also included a EU scenario here. Now, I have no idea if Trump is going to impose tariffs on EU. I simply wanted to look at it for curiosity perspective while I'm doing the work. The trade balance, currently the United States imports $553 billion from the EU. 10% tariff would mean $55 billion of increased tax revenue, and it's about 2% of the U.S. GDP. Now, let's look at what impacts, how these tariffs impact the tax revenue of the United States and why the Trump administration is doing this. Current tax revenues is $4.4 trillion. That's money that the United States government takes in from all sorts of taxes. When we look at this boost as a whole, has been just implemented, we're going to get in, the United States will receive an extra $250 billion of tax revenue annually. That's basically a 6% boost to the total tax revenue that's taken in at $4.4 trillion on an annual basis. Okay, now I promised you at the outset here to show you the economic impact and why a 25% tariff on imports from Mexico is not the same thing as Mexico implementing a 25% tariff on U.S. imports. Here we go. This is now the same analysis, but from the perspective of the Mexican economy, the Canadian economy, the Chinese, and the EU. So let's take Mexico. Mexico imports $265 billion of goods from the United States. Remember, that was 450 the other way around. So there's a roughly $200 billion differential here. Tariff was 25% from Mexico. That means the Mexican economy is going to receive $66 billion of annual tax revenue. Their GDP in USD is $1.8 billion. So the tariff impact that they're imposing on their own citizenry by lifting the prices of U.S. goods is a 15% impact to GDP. So I'm just looking at the trade volume here against the total GDP. That's a 15% move. That's a much bigger impact to the Mexican economy than to the U.S. economy, almost a 10-fold increase. So 1.7% impact on the U.S. economy as a result of these tariffs. Trade that with a 14.7% or 15% impact on the Mexican economy. That's remarkably different, even though they kept the 25% tariff exactly the same. The same can be true about the Canadian economy. So we look at Canada. Canada imports $277 billion from the United States annually, 25% tariff. They're going to get $70 billion annual tax revenue, but their GDP is only $2.1 trillion. Their GDP is 10%, less than 10% the size of the United States. They would be the fourth largest state if they were to join the Union. They would get, so that impact is a 13% impact on their economy as a result of these tariffs. So the citizenry, unfortunately, for the average citizen of Mexico and of Canada, will see a much larger impact on the tariffs that are being implemented than the U.S. citizenry. I think that's a critical lesson here, that the politicians are simply matching a percentage and think, oh, it's pari passu, will just be like 25%, but that doesn't impact, doesn't take into consideration the actual trade volume and the size of their respective economies. Now, China will be less impacted because China imports dramatically fewer goods to the United States than we import from them. So we import $448 billion annually, 10% tariff. China imports from the United States $165 billion, 10% tariff. So on their $18 trillion economy, you're talking less than 1% impact. That's totally reasonable. The EU here, they need to keep the tariff to 10%. Their GDP is roughly similar to China, so you're not going to see a 25% tariff here. It's going to keep it small at 10% to keep the impact low on the relative economies. So this is the summary here of the impact of the two different trade wars, and I think it's extremely important that we understand that the impact here between one country and another is wildly different. And matching a percentage of tariff and saying, oh, it's going to be equal because the tariffs are equal, does not mean the underlying economic impact to the citizenry is going to be the same. And I think there's a huge opportunity here, or a huge risk rather, of this trade war kind of getting out of hand as politicians match percentages, but those percentages impact into the economies is going to be wildly different. So what do you do with this information? Well, it's very hard to understand the true impact. Trump, his first administration, imposed tariffs on China. Those were maintained over the Biden administration. And we saw very little impact in terms of the monetary impact in the economy. So this could be nothing. Also note that corporate profits in terms of their cycle are at an all-time high, and there's a possibility here that a lot of this that a lot of the cost impact are simply borne by lower margins in businesses going forward, and the citizenry doesn't feel the impact. That would be one case on high margin businesses. If you're a low margin business, you're going to have to push that through. If you're concerned about how tariffs are going to impact your portfolio, or perhaps what investments to hold, or how to look at stocks and investments in this dynamic landscape, I would submit to you should follow the channel, hit subscribe, and check out the link to my bio below. I run a cash flow club on my website, cashflowinvestingpro.com, where we unpack hidden value in stocks. And we look for 5 key factors. Number 1, top line revenue growth. We want to see companies that can grow revenue over the long term, over a 10-year period. They should be growing revenue. We want to see earnings growing. That's enterprise level earnings. So this means the operating income, the EBITDA, not earnings per share, which can be manipulated by buying back share a la Coca-Cola. Earnings are lower. However, they buy back stock, so EPS has been going up. You want a business that can grow their earnings. Next, you want to see a company whose earnings translate into growing free cash flow. Check out my video on Enron, the collapse, the largest bankruptcy in the history of the United States. Was profitable at the time of the bankruptcy, even though they were burning cash. So cash flow being paramount, we want to make sure that they generate enough cash flow to grow, to reinvest, pay dividends, buy back shares, do everything you need to, because that is the lifeblood of the business. Next, you want a company with low debt. We want less than 3 times debt to EBITDA. A lot of companies in the low interest rate environment were borrowing cheap money to buy back stock, a la McDonald's. That is ending. That debt is now repriced higher, and they're no longer going to be able to buy back stock to manufacture growing EPS. They're going to have to rely on the share count outstanding, and you're going to see their earnings fall, and the stock's going to fall. So you want to make sure you have low debt. As Buffett says, credit is like oxygen. You don't know it when it's around you, but as soon as it's gone, you'll do anything you can to get it back. So be very careful. You want a stock with low debt so your equity investment has the protection of bond-like collateral, but equity-like upside. If you don't know what I'm saying, please follow the channel where I discuss capital stacks, and it's very critical how you understand how much leverage your company has. And then finally, you want to buy a stock that's reasonably priced. You don't want to pay something too cheap. You don't want to pay too premium. You want to find a decent, respectable, reasonable value that you can buy the stock and hold it for a long term and make money. People do outperform the stock market. It does happen. You just have to pick the right stocks. Finally, I would submit to you that the era of just put your money in an ETF and let it grow is coming to an end. The ETFs simply spread the money around in a mathematical formula. There's really no underlying analysis to figure out, is this stock, is this company well run, have good prospects, make free cash flow? It's just a math formula. And at some point when the market realizes that, you're going to want to own specific names. So I highly recommend you do your own research in stocks. If you want, what we do is we have a cash flow club where every month we have analysts that are submitting cash flow one-pagers into this club for your consideration. They are stocks that we think meet those 5 criteria. We think they're interesting buys, have great business prospects. We kind of lay out a 10-year financial look for you so you can really understand not only what they did today, but what they did historically and be able to judge their performance in a long-term perspective, because if you're buying stock, you're going to hold it for a decade. Do not look at stocks quarter by quarter. They need to be 10-year, 20-year, 30-year returns. If you ever read the book 100 Baggers, you'll look at those and realize that a lot of the stocks that returned 100 times their price were held for 15, 18, and 20 years. Most people hold their stock for maybe 2 years. So ideally, you buy it, you leave it alone, and you go earn more money to buy your next stock. You do not trade on stocks. You end up paying taxes on gains. It's very hard to earn money faster than you're being taxed. So anyways, check out my description below. Hit the like, subscribe button. I appreciate the time. Thanks for letting me ramble a little bit. And we'll see you next when I do a stock review and find one that's really throwing out some good cash and reasonable value. All right, take care. Bye-bye.